Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Powell Industries, Inc., ticker POWL.
Right.
And this is far more than just another industrial stock. We're doing a deep dive into some highly specialized electrical infrastructure. They are headquartered in Houston, Texas, and have been around since 1947.
And their identity is really rooted in custom engineering, not mass production. They are, at their core, solutions providers for these incredibly complex, high-voltage electrical applications.
So we're not talking about off-the-shelf parts here.
No, not at all. Their whole focus is on what they call engineered-to-order, or ETO, custom systems. I mean, think about these massive apparatuses built for distribution, control, monitoring of electrical energy.
And a huge voltage spectrum, too.
A massive spectrum. It goes from low-voltage 480 applications all the way up to medium-voltage systems, capping out at around 38,000 volts. They are a critical supplier for environments that they absolutely cannot tolerate failure.
That distinction right there, engineer to order, I think that's the key to understanding both their success and, frankly, their risk profile. They're custom fabricators, and they sit at this unique intersection of the energy and utility booms.
They really do.
And that brings us directly to our mission today, sort of outlining the central conflict here that really defines the whole investment case for Powell.
Okay.
The thesis is this. Powell is a specialized electrical infrastructure player, betting its record $1.4 billion backlog and 29.4% gross margin will successfully convert the LNG CapEx wave in electric utility growth, despite decelerating Q4 order momentum and the high risk of fixed-price contract overruns.
That really covers it.
So we have to figure out if the financial magic they pulled off in 2025 is, a new structural reality, or if it was just a temporary peak before the industrial cycle starts to slow down.
Well, when you look at the financials for the full fiscal year 2025, it's pretty hard to argue against the idea that they executed near flawlessly. I mean, these were truly record-breaking results across the board.
Move them into a new category financially.
It really did. A financial position they've rarely seen in their history.
Okay, so let's break down that top-line performance first, because the revenue growth itself was robust, sure, but the geography of that growth, I think, tells a fascinating story about where capital is flowing around the world.
It really does. So for the full fiscal year 2025, Powell hit $1.104 billion in revenue.
Which is a solid 9% increase.
A solid 9% jump year over year, yeah. Up from about $1.012 billion in FY 2024. But here's the nuance, right? Domestic revenues here in the U.S., they only increased by a moderate 4%, hitting $880.2 million.
Okay, so just 4% here.
Right. Meanwhile, their international revenues were the real engine. They grew significantly faster. I'm talking a massive jump of 35% to $224.1 million.
Whoa, okay, a 4% domestic climb versus a 35% international explosion.
Yeah.
That is a huge divergence.
It is.
Does that suggest that the domestic U.S. market, maybe traditional oil and gas CapEx, is already showing some signs of fatigue, while these global energy projects are still getting the green light?
It absolutely suggests that. That accelerated international growth, it was driven primarily by two key regions: a lot more project volume from their Canadian operations, and a really substantial uptick in activity within the Middle East and Africa region.
So places with big national infrastructure projects.
Exactly. These are regions that are undergoing significant national infrastructure or energy export investments. It just highlights that the global demand for their specialized, non-commoditized equipment is still incredibly strong, even if the mature domestic market is, moving at a less dynamic pace.
So they're selling these premium specialized products into premium international projects. And I guess that explains how they managed to get that staggering leap in profitability, which is really the head turner in this report.
It is.
A record diluted EPS of $14.86 for the full year. I mean, that doesn't just happen with more volume. That demands maximum operational efficiency.
And that's exactly where the gross profit margin story comes in. The GPM reached an incredible 29.4% for the full year.
29.4%.
Just to put that in perspective, that's an increase of 240 basis points year over year. It climbed all the way from 27.0% in FY 2024.
And getting a GPM near 30% in the industrial fabrication space is, well, it's exceptional.
It is. I mean, that level of margin power, it typically belongs to specialized software firms, not hardware builders.
That margin figure is fantastic, but in the ETO business, the margin is often based on how well you price a contract versus how efficiently you actually execute it months, maybe even years later. Was that 29.4% purely sustainable pricing power, or were there some, favorable closeouts that padded the numbers a bit?
It was a crucial combination, and this is where you have to look really closely at the operational tailwinds. Management was very transparent about this. They noted that strong project closeouts played a significant role.
How significant?
They contributed roughly 125 basis points to that overall year-to-date margin figure.
Okay, let's unpack that. 125 basis points. For our listener, this is really the core of understanding Powell's project-based finance. What exactly does a favorable project closeout mean in dollar terms?
Okay, so think of it this way. When Powell signs a long-term fixed-price contract, they have to estimate all their future costs, right? Labor, materials, sub-suppliers, often 2 or 3 years in advance.
A lot of guesswork.
A lot of educated guesswork. So let's say they budgeted $5 million for the copper components and labor for a big power control room. But because of, let's say, astute supply chain management or more efficient engineering, the final cost comes in at $4.5 million.
Okay.
That $500,000 difference flows directly to their bottom line as a positive adjustment when that contract is officially closed out.
So the company isn't just making high margins on new contracts. They're consistently executing these really complex, multi-year projects under budget.
Exactly. And that precision in estimation and efficiency in execution, that is Powell's operational moat. In absolute terms, these net changes in contract estimates, they positively impacted operating results by a substantial $19.2 million in FY 2025.
And that's up from the prior year?
It is, up from $16.9 million. So this efficiency, it's not a fluke. It's a trend. It shows better cost management. They're just getting better at predicting and controlling the variables in a highly variable environment.
And that kind of efficiency, it has to translate directly into cash generation, right?
Right.
Which is the lifeblood of any industrial business that needs to fund CapEx.
It absolutely did. The cash conversion was very, very strong. Operating cash flow, the OCF, reached $167.9 million.
That's a huge increase.
It's a substantial 54% increase year over year, up from about $108.7 million in FY 2024. And this massive spike was driven mainly by the higher earnings we just talked about, but also by what the company called a steady and predictable allocation of working capital.
Meaning they're not tying up cash unnecessarily.
Right. They're managing cash tied up in inventory and receivables really effectively, making sure those earnings quickly convert to usable cash.
That's incredibly reassuring. But let's go back to the GPM, that 29.4%. The investor in me is always, a little wary of an industrial firm sustaining near 30% margins through a full economic cycle. What are management's expectations going forward? Do they think this is the new normal?
They're remarkably confident. I mean, they anticipate maintaining margins in the upper 20s in FY 2026.
The upper 20s. So they see it as sustainable.
Largely, yes. Their internal analysis suggests that these high GPM levels are sustainable mainly because of two things. First, the continued high-value content of the projects that are already in the backlog, and second, their own demonstrated ability to execute these projects so efficiently. They really believe their specialized ETO position supports these premium prices.
Especially in the growing utility and LNG sectors.
Especially there, yes.
That confidence leads us right into the most crucial asset they have, which is the backlog. It's the fuel for future revenue, but we have to check the momentum because if that backlog stops growing, the stock price is going to struggle no matter how high the margins are.
And the backlog story is, it's a classic industrial tale of, let's say, massive scale meeting some emerging caution. Powell finished FY 2025 with a colossal, a $1.376 billion record backlog.
A record.
A record. This is their inventory of committed future work, and for a custom fabricator like them, this provides exceptional financial foresight.
So how does a huge number like that, $1.4 billion, translate into guaranteed revenue for the year ahead? What's the visibility look like?
It provides really strong revenue visibility. Specifically, this backlog translates to approximately 60% revenue visibility into FY 2026.
60%.
If you put that into dollar terms, it means about $824 million is already expected to be recognized as revenue in the coming fiscal year.
For an industrial business that's, so prone to project volatility, having over half of next year's revenue basically guaranteed is It's an immense de-risking factor.
It absolutely is, and it justifies a substantial valuation premium. And overall, for the full year, their orders were $1.2 billion, which matched their revenue, giving them a strong full-year book-to-bill ratio of 1.0x.
A 1.0x full-year book-to-bill is exactly what you want to see. New orders are perfectly balancing the rate you're burning through old ones. So we've got a record backlog, high revenue visibility, strong margins. Where does the caution that we mentioned in the thesis actually come from?
The cautionary signal is it's entirely visible when you move from the full year numbers and you zoom into the quarterly data, specifically Q4.
Oh, okay.
This is where the momentum check shows real signs of strain. The critical Q4 book-to-bill ratio fell significantly to 0.9x.
So it fell from 1.3x in Q3 all the way down to 0.9x in Q4. That is a major deceleration.
It is.
And when your book-to-bill is below 1.0, that just means you're burning through your backlog faster than you're refilling it with new orders.
Exactly. So while the backlog is still near record highs, this deceleration reflects a lack of what management usually relies on, those mega deals in Q4.
And more worryingly,
this drop coincided with acknowledged decelerating momentum in some of their core traditional markets. And they were specific about it. They cited parts of the traditional oil and gas and petrochemical markets.
like what?
Naming facilities like refineries, polyethylene, and polypropylene plants as showing, softening demand for new CapEx projects.
So their historical foundation, the bedrock of their business, is starting to look a little less steady. I mean, oil and gas is still, 33% of the backlog? Even if that percentage is shrinking, isn't softening demand in a major segment like that a bigger immediate risk than the potential reward from a nascent LNG wave?
That is the critical question the market is wrestling with right now. The long-term LNG wave is massive, but it takes a long time for those mega projects to turn into actual orders. Meanwhile, if the traditional refinery cycle slows down dramatically, that 33% segment could become a margin drag, or worse, just lead to more order declines in the immediate future.
And this softening is also tied to some pretty clear geographic divergence, right?
Yep.
Which suggests that global competitors are having an impact in certain regions.
Precisely. You're seeing competitive and geopolitical influences creating these imbalances. Markets like Canada and the regions covering the North Sea and the UK are showing signs of being softer.
And in those subsectors.
In those subsectors, the demand environment is just less robust. And that's forcing Powell to compete aggressively on price just to secure the few projects that are available.
Which is a red flag for future margins.
It could be. I mean, if they're forced to discount their highly specialized products in those specific regions, it definitely raises a flag about potential future margin compression, at least in those contracts, even if the overall company margins stay high because of, say, the U.S. utility boom.
This transition pressure, this softness in traditional markets, it makes the diversification strategy, which is our next section, not just a nice-to-have bonus, but an absolute necessity for the company's future.
It really is. And the strategic pivot away from relying so heavily on the cyclical nature of core oil and gas has been a really pronounced success, and it's maturing rapidly.
So that reliance on a single sector is being offset.
Substantially offset by new engines of growth that have shown some real stamina.
Okay, so break down those numbers for us. How much does traditional O&G account for now compared to these new growth areas?
The numbers are pretty powerful. The electric utility and the commercial and industrial, or C&I, sectors, they now account for 48% of the total backlog, almost half.
And how does that break down?
It breaks down really nicely. 33% from the utility segment and 15% from C&I. Meanwhile, the historical core, oil and gas, that's now down to 33% of the backlog.
So a big structural reduction in risk
A
concentration.
huge reduction from historical norms, yes.
Okay, let's spend some serious time on that electric utility segment because its performance is, it's explosive. And it's the key factor right now that's masking the softness elsewhere.
It is the absolute star performer. The electric utility segment revenue increased by a massive 50% year over year.
50%.
To reach $279.0 million. This growth is directly driven by these long-term capital expenditure waves across North America. We're talking investments in new substations, grid hardening, a resurgence in power generation.
And a big utility award, too.
The scale of their success is really underscored by the fact that in Q3 of FY 2025, they secured the largest electric utility award in the company's entire history.
Securing the largest utility award ever in one quarter.
Yeah.
That's a massive signal they're winning high-value work from the big players. But the momentum didn't stop there in Q4, did it?
No, it actually accelerated. To put a fine point on it, the utility segment revenue specifically doubled. It was up 100% in Q4 compared to the prior year quarter.
100% in a single quarter.
That kind of exponential quarterly growth for an established industrial player is almost unheard of. It just speaks to the enormous immediate demand they are capturing in the grid modernization space. This segment is robustly compensating for any softness in petrochemicals.
So if the utilities segment is all about grid hardening and power generation, what's driving the commercial and industrial, the C&I segment? That's 15% of the backlog.
The C&I growth engine is really dominated by one technology trend: hyperscale demand for data centers.
Data centers.
Data centers account for roughly half of that C&I backlog. And this is where Powell really shows its ETO specialization. They aren't just selling, generic circuit breakers.
So what's the technological alignment here? Because the whole AI revolution requires specialized power infrastructure that traditional utilities don't usually deal with.
Right. They're providing specialized solutions like DC switchgear for 800V DC architectures.
Okay, so that's crucial.
It's absolutely crucial for new generation data centers that are powering AI and cloud computing. Traditionally, data centers used AC power, but DC systems are becoming essential because they eliminate several conversion stages.
So they're more efficient.
Dramatically more energy efficient, and they reduce heat loads. Both are critical factors for these massive AI processing farms, so by offering specialized 800 VDC switchgear, Powell is positioning itself right on the technological frontier. They are embedding themselves into the physical infrastructure that powers all this capital spending we're seeing in high-performance computing.
That deep level of specialization, that's what creates the moat. They're engineered into the tech infrastructure, not just passively supplying generic parts. Are they using other smaller segments to sort of buffer the risk?
Yes, the portfolio is definitely broadening. They're smaller, but you can see the diversification in sectors like traction. They secured a light rail order in Q3 in mining, where they got a large potash project. These smaller wins just add stability against the huge swings in LNG and utility work.
And to make sure they stay leaders in the automation and data integration side of this, they also made an acquisition, Remsdaq. This seems like a move to get them up the value chain from just pure hardware.
The Remsdaq Ltd. acquisition, yeah. It was completed in August 2025 for a total of $18.4 million, which included about $4.6 million in cash that they acquired. And this move is fundamentally about accelerating Powell's electrical automation strategy.
Okay, for a listener who understands their core business is building these massive steel and copper electrical rooms, explain what Remsdaq actually brings to the table technologically.
So Remsdaq specializes in what's called SCADA RTs, that's supervisory control and data acquisition remote terminal units.
Okay.
These units are vital for substation control, transmission, and distribution. Essentially, they are the hardware interface that lets engineers remotely monitor, control, and gather massive amounts of data from the highly complex electrical systems that Powell designs and installs.
So it's the intelligence layer on top of the physical power infrastructure. This moves them from just selling a physical box to selling an integrated solutions platform that includes ongoing data and analytics.
Exactly. Management even noted this allows them to offer asset management through data and analytics. It transforms them from just a hardware provider into a modern integrated solutions provider. And that increases the stickiness of their products and potentially creates recurring service revenue, which investors love.
That integration presents its own challenges, though. I mean, integrating a specialized software company into a legacy engineering and fabrication culture is notoriously difficult. Is there a timeline or a major focus on making sure Remsdaq delivers value quickly?
Well, the timeline is sort of implicit in their strategy. They need to show rapid value add and new utility and data center bids. And you're right, integration risk is always there when you merge hardware and software firms. But the strategic fit seems so clear applying modern automation to their traditional indispensable products that their rationale is very strong. They're future-proofing their equipment.
And this level of complexity brings us to the execution strategy. Powell's success really hinges on their product being absolutely indispensable, sitting at the junction of the highest value and the highest risk for their customers.
That is the core of their value proposition. Their specialized equipment, especially those massive prefabricated power control rooms, the PCRs, they are not just plug-and-play components. They are integral to major projects and are typically positioned on the critical path.
Define critical path in this context for our listener.
So if you're building a multi-billion-dollar LNG facility or a massive substation, there is one sequence of events that cannot be delayed without delaying the entire project: Powell's PCRs and switchgear are often the most complex, most customized electrical components, and they have to be installed and commissioned before anything else can safely power up.
So if Powell misses its delivery schedule by 1 week,
The entire multi-year, multi-billion-dollar construction project could stall, and that would cost the customer staggering amounts in liquidated damages and missed operational timelines. And that's why customers are willing to pay a premium for Powell's specialization.
it sounds like tremendous leverage, but also tremendous risk on Powell's side. Give us a sense of the coordination that's required for just one of these typical PCR projects.
The scale is immense. A typical PCR project is a logistical and engineering masterpiece. It involves something like 45 dedicated engineers working on the design. They have to coordinate with roughly 97 separate sub-suppliers globally,
97.
sourcing around 4,400 purchased components, and ultimately generating about 750 complex electrical and mechanical drawings. They have to deliver a fully complete, integrated, and tested solution. That complexity is the engine of their moat.
And since they're sitting on such strong margins and a fortress balance sheet, they're clearly leveraging that strength to go capture future market share, specifically targeting that next big energy wave, LNG.
Absolutely. The forward capital commitment is explicitly designed to secure market share in these high-growth areas. The biggest commitment they've announced is the $12.4 million Jacintoport expansion investment.
And that's mostly for FY 2026.
Predominantly, yes. And this isn't just some minor facility upgrade. This is an aggressive commitment to capacity ahead of getting the major orders.
So what does this expansion actually entail? What are they building?
It's highly targeted toward fabrication and marine logistics. They're adding an incremental 335,000 square feet of productive capacity for the power control room laydown area.
That's a huge increase in yard space.
It's a massive 62% increase. And crucially, they are also doubling their shoreline bulkhead length to 1,150 feet.
Why is doubling the shoreline bulkhead so important?
Because these PCRs are often shipped directly by barge from their Houston facility right to the construction site along the Gulf Coast, places like Sabine Pass or Corpus Christi. Doubling the bulkhead length gives them significantly more flexibility for large marine shipments. It means they can stage and load multiple massive PCRs at the same time, which lets them service several major LNG projects concurrently.
So this $12.4 million investment is a very calculated, very aggressive bet that this multi-year LNG project wave, expected over the next 3 to 5 years, is going to absorb all that new capacity. They're positioning themselves to be the leader for this specific type of fabrication work.
It is a high-stakes, forward-looking move. They're betting their current efficiency and expertise will win them a disproportionate share of the new LNG CapEx. And they can afford to make this bet because, like you said, their balance sheet is the ultimate cushion.
Let's just confirm that financial stability because it really does underpin this whole growth strategy.
The balance sheet is a fortress. The company operates with zero debt under its $150 million revolving credit facility.
Zero debt.
Zero debt. And on top of that, their liquidity position is pristine. They've got approximately $476 million in cash, cash equivalents, and short-term investments. That level of cash and zero leverage gives them immense freedom to execute this expansion, buy assets like Remsdaq, and weather any unforeseen project delays.
Okay, so we've established a company with record financials, strong growth engines in utilities and data centers, and a cash position that allows for aggressive expansion into LNG. Now we have to synthesize this. We arrive at the final verdict, weighing all that momentum against the structural risks.
And the central question for any investor is whether the current market valuation premium is fully justified. Based on typical investor analysis, the market seems to be giving Powell a high premium implied around a 19x forward PE valuation.
19 times forward earnings. That's typically reserved for faster-growing software or tech firms, not specialized industrial fabricators, even highly successful ones. Is that warranted, given the industrial cycle?
The bull case would emphatically say, yes, it is. I mean, the $824 million in FY 2026 revenue visibility, that provides a huge amount of certainty. It de-risks the coming year.
And the growth engine is proven.
It is. The robust electric utility growth, plus the specialized data center demand, proves they've successfully mitigated that historical concentration risk in oil and gas. And that 29.4% GPM, which management thinks they can keep in the upper 20s, that just commands a premium multiple.
Okay, however, the bear case has to focus ruthlessly on the structural risks that are inherent to their unique business model. We touched on it earlier, but let's really dedicate the time to the biggest risk of all, the fixed-price contract risk.
This is the mandatory risk factor, and it's a fundamental challenge for any ETO company. The vast majority, we're talking 96% of their revenue, comes from these long-term fixed-price percentage of completion contracts.
And this reliance is so crucial.
It's so crucial that it was highlighted as a critical audit matter, or SHIM, in their regulatory filings.
What does it mean when the auditors identify something as a critical audit matter?
It means that the auditors see the process of determining those future cost estimates as one of the most complex, subjective, and difficult areas of judgment in the entire financial statement review. Every single percentage point of margin we just celebrated is fundamentally based on management's ability to accurately predict these highly volatile future costs.
And if they get those costs wrong, or if macro conditions change,
that margin is instantly eroded.
what specific factors are most likely to cause these contract overruns in today's environment?
The risks are really compounding right now. First, sustained inflation on raw materials like copper, aluminum, and steel. If a project runs long, they have to buy materials at inflated future prices, but they're locked into the original lower price with the customer.
Right. And labor.
Second, persistent labor shortages for skilled engineers and fabricators, which drives up wage costs. Third, increased costs from tariffs or trade policy changes. And maybe most critically, delays or failures by their third-party suppliers, which limits Powell's ability to pass on those rising costs. They have to absorb them.
So in other words, their massive moat, the complexity of coordinating 45 engineers and 97 suppliers, is also their Achilles heel in a high inflation environment. And if those delays happen, they face real tangible penalties.
Yes, they do. They face a contingent liability for liquidated damages, penalties if they fail to meet a schedule or a performance obligation. As of the end of the fiscal year, they noted a probable exposure of $3.7 million in liquidated damages, with a possible exposure up to $4.3 million. These are not theoretical risks. They are real dollar amounts tied directly to execution failure.
And beyond just execution, the competitive environment is relentless. Even with their specialization, they aren't operating in a vacuum.
No, the industry is fiercely competitive. While Powell focuses on ETO specialization, many of their competitors are global giants with substantially greater scale and resources. We are talking about major players like ABB, Eaton, and Schneider Electric.
And they can afford to underbid them.
They can often afford to underbid on less specialized parts of a contract, leveraging their sheer scale to maintain market share. And that pressures Powell on price, particularly in those softer regional markets we talked about, like the North Sea or Canada.
Finally, we have to return to that Q4 momentum check. The market has priced this stock for stellar execution and continued large orders. What happens if that Q4 slowdown was structural and not just transitory?
Well, if the Q4 order slowdown, where book-to-bill dropped to 0.9x, continues, and if the backlog susceptibility to cancellations or scope reductions is triggered, the market is poised for a correction. That premium valuation assumes the LNG and electric utility segments will continue to grow exponentially.
And that Powell will win all of those contracts.
Nearly all of them, yes. If that backlog conversion can't quickly and consistently mask the decelerating momentum in their core traditional markets, that 19x valuation will look very shaky very fast. The risk is that the recent slowdown signals a broad exhaustion of the industrial CapEx cycle before that new LNG wave fully materializes.
And that brings us to our final thought for you, the listener, as you consider this complex player. Powell's success hinges entirely on the specialized nature of its engineered-to-order product line and whether that complexity provides a sufficient competitive moat against larger, lower-cost competitors during a period of sustained high inflation and supply chain strain. They've achieved remarkable financial success by mastering complexity, but complexity is always the greatest risk when you're locked into fixed-price contracts. They are betting $12.4 million that their moat is strong enough to capture the LNG wave, but the market must constantly scrutinize whether that $19.2 million positive impact from project closeouts in 2025 can be replicated in 2026 and 2027 if inflation surges again.
It's a perfect illustration of high reward stemming from high operational risk. A phenomenal business, but one that demands flawless execution in a volatile macro environment.
Risk defined.
Yeah.
Portfolio protected.